So in terms of reviewing which companies did well and where the equity markets went in 2013, we can look at simply the fact that the most shorted companies outperformed the S&P 500 quite strongly. So it's been a mad year where it was sort of a risk rally. You were not paid to be highly cautious and screen for all the traditional metrics of profitability and sustainable earnings. It was a year to sort of own companies which were, started the year perceived to be in a little bit of trouble. So we had kind of rebounds from the likes of Netflix, from Tesla. Even over in Europe, you had things like Alcatel-Lucent, their restructuring finally paid off. Nokia, they managed to find somebody to buy their sort of networking business. And so one of the only companies that didn't find a way out was BlackBerry. But generally, it's just been a sort of risk rally. And according to our sort of factor analysis, it's really about momentum. So companies that were rising in price carried on rising in price. It's a sort of momentum-driven risk rally. So it's interesting to sort of stop and take heed of that to help inform what might happen next year. Yeah, so if we look at the fact that the US equity markets are up, between 20 and 30%, depending upon whether you're looking at the NASDAQ or the S&P 500. Japan is up 55%, UK is up 10%, 24% for the FTSE 350. It's kind of like, well, where is the rating? Now, most markets are on a historic PE of around 18. And if you look at, is that sort of high or low? Well, if you look at the last 25 years, the low is about a PE of about 12 and the high about 25. So the bad news is that we're sort of really in the middle there, and it could go either way. And as we go into next year, it very much depends upon whether you take the the bullish case or the bearish case, and things are very evenly balanced. On the fundamentals, you can't really make a hugely bullish case for the market to re-rate higher. It's much easier to make a bearish case, and the economists, they're paid to analyse economic data, and the economic data is okay. There is an element of growth, but they would argue that is very much driven by central bank stimulus, by cheap money, which is sort of forcing companies to take risk. But actually what companies are doing with their cash is they're doing share buybacks, raising their dividends a little bit, and they're sort of fiddling internally and divesting themselves of less profitable divisions or non-core units, which is not the kind of activity which spurs very sort of exciting top-line sales growth when they're just essentially driving down costs and squeezing out profitability from their existing operations. So the economists can say that the sort of the bear case is pretty bleak. We haven't really dealt with a lot of the sort of structural problems, i.e. the aging population, big youth unemployment, stagnant wages. So they're kind of pointing to that. And they also say that the remnants of the credit crisis are still with us. You've still got lots of European banks holding on to lots of bad debt, still not worked through the system. Now the big bull case scenario, though, is that there's simply going to be a very slow tapering of quantitative easing. It might begin with the Fed announcement tomorrow. But with money so cheap, which is likely to be the case certainly into next year, you've got little alternative if you want some growth and some income but to put your money in equities. So as a sort of default, the equity markets might continue to see money coming in and they might go up next year. That's really the key argument.